Hello and welcome to the Denticon and TUSK Exit Strategy and Selling Your DSO webinar. This is a webinar that was originally broadcast 2 weeks ago. Unfortunately, we had a problem with the recording device and it didn't capture the actual webinar in live fire environment. We were able to get the PDF deck out to all the attendees, but a number of people wrote back and said they really enjoyed the webinar and they wish they could somehow get a recording for it. So I'm going to try to do the next best thing today, which is go through the deck one more time with some verbal inputs from me throughout it. It's obviously not live fire the way it was originally with Q&A at the end, but hopefully it'll suffice. So thanks in advance for listening a second time or multiple times. This webinar, as I said, is hosted by Denticon and PlanetDDS as well as TUSK partners. PlanetDDS was the first to offer cloud-based software over a decade ago with its Denticon practice management system. Denticon's the only fully functional, mature practice management software product that allows for true multi-location capability in the cloud. They're one of Inc. magazine's 5,000 fastest growing private companies in the United States. The bulk of that growth is due to the fact that the dental industry is consolidating, and we're going to talk about that a good bit today as well as on future webinars. This consolidation has created a need for multi-location capable software packages, and there are not many out on the market nowadays. Denticon is one of the most noteworthy of all of them. They have some of the most successful and forward-thinking dental groups in the industry on the software, and some of those logos you see in front of you right now on this slide. One of the ways to get a higher multiple at exit is to have many systems in place, and one of the most critical systems is your practice management software. Too many groups are still running a patchwork quilt of desktop legacy solutions that really don't communicate with one another. Suffice to say, Denticon is a breath of fresh air for an established company that's been in the business for over a decade and has been producing wonderful results for all of its customers. I encourage you to take a closer look at them. TUSK Partners offers industry-leading resources for emerging DSOs and group dental practices. In short, we help you start, grow, and sell your group dental practice or DSO. My name is Perrin Desports. I'm going to be your host for this webinar as well as ones to come in the months to come. I got my background and spent most of my time in the distribution space of the dental industry. The last 15 years specifically with Patterson Dental Company. I ran 3 different businesses for Patterson, from Richmond, Virginia to Metro New York, New Jersey, and then Charlotte, North Carolina for the last 7 years before I joined 2 industry colleagues to launch TUSK Partners. One of the most notable aspects of my time in the dental distribution space is the beginning of the consolidation of the industry. We see that at enterprise level with groups such as Heartland Dental, Pacific Dental, Aspen Dental, all the names that you all know very well. But there are also a lot of smaller, regional, maybe sometimes single state-based group dental practices that are coming on the scene with fast growth rates and aggressive plans for the future. Many of those founder, owner, operators have launched their group practice and have the intent of bringing their business to market and ultimately selling it, possibly to a financial buyer or maybe a strategic buyer at some point in the not too distant future. For them, this webinar will be hopefully very informative and will give a lot of background and overview on what they may be looking at in the years to come. So let's start by taking a quick overview of the dental industry as it relates to this movement of consolidation. We'll give you a present and future outlook on it. We'll address what's happening in the dental economy and try to address why DSOs and private equity are buying dental practices these days, giving you a little bit of context around both. So as we all know, there's a massive roll-up of dental practices that's occurring right now. And a lot of the drivers behind that are aspects such as student debt and then the retirement of the baby boomers and people living longer and valuing their overall oral health. There's also the systemic link between oral health and heart health that is causing a lot of people to take a second look at making frequent visits to the dental practice from a preventative standpoint. This consolidation trend really began a little bit over a decade ago, and it's picking up steam very quickly. And depending on who you ask, the industry overall is somewhere between 15 and 20% consolidated, meaning it's not very consolidated. It still has a long way to go before we reach the numbers of the other aspects of medicine. A lot of the consolidation is occurring in these smaller groups, and really the face of corporate dentistry now is a local dental group. There are well over 1,000 dentist-owned group practices and DSOs in the market today. So why is private equity so interested in the business of dentistry? Well, if you think about it, the practice of dentistry, first and foremost, is a very lucrative endeavor. Dental practices, by and large, do extremely well. They put a lot of money to the bottom line, and it's a very profitable business. They're largely recession-proof too, and a lot of that is based on the fact that many patients still get their teeth cleaned twice a year. So there's a residual income aspect of the business of dentistry that a financial buyer loves to see in terms of repeat business, consistency and continuity of future revenue streams. There are also economies of scale the larger you get, and you see that from a lot of the platform plays that centralize call centers and insurance processing and marketing functions and financial functions and everything like that. Functions that you don't have to keep located in the individual dental practices. You can put them in a central hub and spoke type setup. In terms of an asset class, the practice of dentistry is less risky than other healthcare verticals right now, and a lot of that is because there's still a lot of upside to those businesses. And the other thing is that there's a lot of cash sitting on the sidelines in private equity funds right now. As a matter of fact, in 2016, there was an additional $270 billion invested over the prior year, and 89% of private equity funds met their capital raising targets for that year. And that was an all-time high. We'd never seen that before. The typical goal of private equity groups is a 3 times return in 5 to 7 years. Another way of putting that is that private equity's objectives are to return 300% to their limited partners in a 5 to 7 year time frame. Those returns are slightly better than you're going to get in the stock market overall, let's say. I'm being facetious. They're incredible. 9 of the top 10 DSOs, and these are the names that we all know and love, are private equity backed. And when we talk about the opportunity where a private equity fund is going to want to return 300% to their shareholders in a 5 to 7 year hold period, you can sort of see those numbers played out on the screen in front of you. And let's take Heartland Dental. They're at the top of the list in terms of number of locations, and it makes for a little bit of an easy illustration. What we're showing is the number of practices that each of these businesses had in 2011, the number they had in 2014, and the number they ended the year with in 2017. And for Heartland in 2011, they had about 300 practices. They closed the year in 2014 at about 550 for an 83% growth rate in terms of number of locations, and went from 550 to 800 in 2017 for another 45%. Over that 6-year period, that's 167% growth in the number of locations. And you see strong triple digits all the way down the right-hand, in most of the right-hand column there. So while locations doesn't always translate directly into revenue growth of the same number or profit growth of the same number, it's a pretty safe estimator of how those businesses are growing and how they're making returns to their private equity backers. This is a slide that breaks down what I call the segments of the pie. And in 2016, private practice made up about 3/4 of the overall practice of dentistry. That's the box on the upper left. Private practice, single doctor, single location being 75% of the market. Your middle market, which is 2 to 25 locations, roughly speaking, is about 13% of the market in 2016, and your elite groups make up about 12% of the market. Those are 25 locations or greater, and many of them are represented on the prior slide. So as we shake our crystal ball and wait for the clouds to dissipate, what does this look like over the next 5 years' time? Well, private practice drops from about 3/4 of the market to about 60% of the market. The middle market group, which is this one in the middle, 2 to 25 locations, goes from roughly 13% of the market to about 25% of the market. And your elite groups grow from about 12% to about 15%. Now, those are just the ways the overall pie, the distribution of the pie, shakes out. The more important numbers on this slide are the ones that indicate compounded annual growth rate, or CAGR. Let me erase that. Try this one more time with a better pen. There we go. So private practice shrinks from 3/4 of the market to about 60%. And over that period of time, those businesses are only growing at about 1% compounded annually. If you pay any attention to the national financial news, you'll know that in 2017, many economists say that the US GDP grew at about 2.3%, the overall economy, the macro economy, growing at about 2.3%. So these businesses, the individual location, solo dentist, private practice, are not keeping up with the overall growth rates of the macro economy. On the other hand, when you look at the other two segments, your middle market groups are growing at 12 to 15%, and your enterprise level groups are growing at 10 to 12%. Strong double digits in both cases, and 4 to 5 times as fast as the US economy overall. This is where you're seeing a lot of marketing dollars, a lot of savvy operators really growing new patient counts, as well as the revenue through service expansion and the like in all of these businesses, and really pouring some secret sauce on it to create greater returns, either for themselves or for, in some situations, their private equity backers. So let's pivot for a second and move to talking about a marketed sale process. And by this, I mean taking your business to market and selling it. We're going to go through time frames and set some realistic expectations. So what should you expect when you take your business to market? I'll start by saying that this is typically an emotional roller coaster. Understandably, there are a lot of dollars at stake, and people start to wrap their heads around the money that they stand to make for the sale of their business. And it gets to be quite a roller coaster as the deal ebbs and flows. And nothing is ever smooth or predictable. Everything is negotiable. And this is a process that's categorized by high emotions. It is also one that can be rather lengthy. Sometimes a deal can wrap up in as little as maybe even less than 90 days, but they typically take a good bit longer than that, and some take as long as 9 months to a year. And that's not even to say that the deals get done in the end. Sometimes they drag out for quite a while and actually don't culminate in a sale. Selling a group dental practice or a DSO is nothing like buying or selling a solo dental practice. Many smaller groups grow by acquisition, meaning the founder, owner, operators may have 10 locations as an example, and their goal is to buy 2 practices per year over the next 5 years and double their footprint from 10 to 20. And buying a solo dental practice and incorporating it into your business empire is a lot easier, a lot faster, lot more simple process, candidly, than it is to take your 20 location business to market and sell it. The dynamics are completely different. There's a preparation to go to market phase where sometimes you need to focus internally and clean up some issues before you want to position it for sale. There's the process of being in market to attract any and all buyers. That could be financial buyers, it could be strategic buyers. The due diligence phase is one that's marked by a lot of detailed information requests and detailed responses. In short, people want to know exactly what it is they're buying when they buy your business. And then the selling price, deal structure, and negotiation involved in it can get to be very complicated and lengthy based on the desires of both the buyer and the seller. So let's take a look at what a marketed sale process may actually look like, and we'll detail some of the steps as we go through this. The first is marked by discovery, and that's where you're going to meet with the group that'll take your business to market, and that brokerage group, the group that's going to sell your business and help you with the transaction, needs to uncover all the different bits and pieces that make up your business. And that's not just financial and quantifiable data. It's really about learning the story of the business itself and being able to communicate it accurately to the market. The idea being that you want whoever buys your business to focus on not just the number that they're paying for it, but what the upside is for them after they acquire it. The valuation is built, and that's a pretty thorough analysis of the business with EBITDA add-backs and really justifying how we arrived at the multiple we did and the number that we're hanging on the business in hopes of attracting potential buyers. The story development is a phase that we take our time with to build the book that we take to market. And it's one where, again, we're trying to communicate as much about the upside for a potential purchaser to see the business in the most rose-colored glass as possible. The marketed process is one where that book is communicated out to the industry to try to attract any and all potential buyers who could be interested in your business to engage in a conversation. Obviously, the more buyers there are for a business usually indicates the better selling price for the seller. And then the due diligence phase is one where a lot is uncovered, where a buyer is going to uncover a lot about the business and do a thorough exam of multiple aspects of it. Negotiation being one where the details of the transaction matter from an immense standpoint, and there are usually many, many dollars tied to that. We're going to focus on two aspects of this, due diligence and negotiation, in this webinar in the next couple of slides here. I realize this is a lot, but there's really no other way to break it down here. So the typical transaction process from offer to close can be lengthy, is very thorough, marked by a lot of communication and a lot of information requests. So an initial offer comes in from a private equity group, a financial buyer, or a strategic buyer. And the letter of intent, or LOI, is negotiated. That's the letter of intent starts to detail more about the way the transaction will play out and the details of the transaction and the way it'll be structured. It's a non-binding document that either side can get out of, though, if the situation goes bad. There are three aspects that I think most small groups really need to be aware of in this process. One is called quality of earnings, or Q of E. The next is operational assessment, and the third is clinical review. These three pieces are what a buyer um, undertakes to gain a clear line of sight into all aspects of the business that they're interested in acquiring. Quality of earnings is performed usually by a CPA firm, and they do a thorough exam of tracing all revenue, expense, and profit through the business to validate the financial integrity of the business, essentially. You will find that a number of smaller groups will actually undertake a quality of earnings report upon themselves before they go to market. And this is usually a prudent step, because if the quality of earnings report uncovers anything that needs to be cleaned up, better documented, validated, changed, or what have you, it's usually better if the group can have an objective third party identify those situations and then be able to clean them up according to a level of priority and on their own time. If a quality of earnings report is performed at the request of an acquirer, and the quality of earnings report identifies any areas that need to be investigated, you're kind of under the gun at that point to either justify them or acquiesce to a lower possible purchase price. I think the quality of earnings reports that we see that are undertaken by smaller groups before they go to market usually result in more substantiated financial reporting, and it usually tends to make this part of the process go more smoothly during negotiation. The next piece is operational assessment. The prospective buyer is going to send in an individual or a team of individuals to identify and assess all areas of the operations of the business. It could be anything as seemingly simple as policy and procedure manuals to the way the business is run from an HR standpoint, and everything else about the operations of the business. They want to learn more about your process and procedure and how, frankly, consistent it is from one location to another, but also how congruent it may be between your business and their business. And the final piece in terms of review is clinical review. The prospective buyer is going to send in usually a dentist or a former dentist to do a complete and thorough chart audit, as well as identify from a risk compliance standpoint the way you're documenting, presenting treatment, documenting notes in clinical reviews, as well as your billing systems if you're billing any third-party payers and the like. This is one where the clinical assessment can really have a lot of jeopardy for the prospective buyer if the seller is not buttoned up very tight from a consistency standpoint. And we see that not often, but when we see it, it usually has a degree of magnitude to it that it can be substantial. Assuming that all three of these pieces check out okay, then the deal is usually submitted and approved for funding internally from the buyer. Legal documents are drawn up. The structure of the deal is negotiated, and a closing date is set. So let's dissect the buy side and talk about the difference between financial buyers and strategic buyers. As I said, they do fall into two different categories. Strategic buyers are going to be your current operating companies, your Heartland Dentals, Aspen Dentals, and the like, that are already established and in market, and they have centralized infrastructure, and they're looking for either single locations or smaller groups to help them grow their market share. Their goal is to identify companies whose products and services synergistically integrate with their existing business. Financial buyers are typically your private equity firms, known as financial sponsors. They're in the business of making investments in companies and realizing a return on their investments, and typically selling the asset at some point in the not too distant future. Examples of financial buyers include Blue Sea Capital and Berkshire Partners and the like. So this is an interesting slide because we took a deep look at a study that Pepperdine University conducted about 2 years ago when they analyzed the overall economy and then broke it down into different sectors in a way of peeling back the layers of the onion, so to speak, on your typical merger and acquisition activity in different sectors. In the U.S. overall, strategic buyers pay more than financial buyers. And that's in the U.S. overall. Sometimes the premium can be more than 50% more that a strategic buyer will pay relative to a financial buyer. That's not what we're seeing right now in our industry. And it kind of begs the question, why? Well, if you think about it, dig a little bit deeper, and try to answer the question why financial buyers are paying more than strategic buyers in dentistry, there are a couple of reasons for that. The number of private equity groups is still, relatively speaking, at an all-time high, or not far off from it. The amount of capital that they have to invest is at an all-time high. You see that on this slide on the right-hand side here as it relates to the total volume of assets under management. The dental market specifically is still in the very early stages of consolidation, and there's more financial than strategic buyers wanting to get into the dental market itself. For those financial buyers that are not presently represented, there's a rush to get in and they're willing to pay more. So competition for those assets is pretty strong right now, and your strategic buyers are a bit more disciplined as it relates to what they're willing to pay. So what you see in the overall economy is not what you see in dentistry right now for a couple of reasons. Let's take a look at multiples and comparables off of that study. And before we do that, let's define an acronym or a term that probably very many of you have either heard and may be familiar with, and it's called EBITDA. EBITDA is essentially normalized cash flow, and it's a way of looking at two different businesses side by side. The government allows you to take things that are called non-cash deductions. You see those on a profit and loss statement. It minimizes your taxable income. It's somewhat to the advantage of the business owner. But if you just compare two businesses side by side from a profit and loss standpoint, and you say which one is more valuable, you really can't draw a conclusion off of that, because one business could have many more non-cash deductions than the other, so it's showing less profit to the bottom line that's taxable, but it could be generating much more cash flow. And if you're going to be purchasing a business, at the end of the day, what you're really interested in doing is getting your hands on the cash that business generates. So EBITDA is a way of trying to normalize cash flow between two different businesses, and it stands for earnings before interest, taxes, depreciation, and amortization. It's the metric by which all transactions are measured in today's merger and acquisition world, and certainly in dentistry. So that Pepperdine study that I mentioned earlier broke down a number of aspects of the overall economy into different business industry sectors. And I want to draw a little bit of compare and contrast here for you because this is an interesting time that we're living in. So I realize there's a lot to this slide, but if you look at here in the upper left, the EBITDA breakdown, the study breaks down businesses that are basically $1 million and less in EBITDA, those that are 1 to 5, and those that are 5 to 10. And in the US overall, the businesses that are $1 million and less in EBITDA trade at about 4.6 times. Healthcare and biotech, which is where dentistry falls, trades a little bit south of that, roughly 3 times. But we see groups, dental group practices and DSOs trading in the 4 to 6 range, which is what you see here on the right-hand side. So dentistry is a couple of turns better than the sector that it falls in, healthcare and biotech, and it's still a turn to 2 better than the US average overall. Those numbers continue to bear out as you look further and further down the group dental practice and DSO metric that we have on the right there. That's a graphical way of saying it's a great time to be in dentistry in general, but it's also a wonderful time to be building businesses that could be ripe for sale in the coming months or year. This is a table that further illustrates some of those multiples and some historical perspective relative to the way some of these businesses have traded hands. Just as an example, the Gentle Dental deal with Linden Capital here that traded in October of 12. Gentle Dental was roughly 8.2 million in EBITDA, and it traded at a 9.8 times multiple, which yielded an $80 million enterprise value when Linden Capital bought them. Several years later, the Decadental deal of July of 15 was an EBITDA business of roughly 7.4 that sold for about 134 million, which is an 18.1 times historical multiple. And it's an interesting deal because Deca was a de novo business endeavor, meaning they were not in the acquisitions business. They were starting dental practices from the ground up, very disciplined operations team, knew their numbers cold, and at the point the business sold, they got credit for leases that they had signed and a number of other forward-looking characteristics. So this business, from a historical standpoint, was trading at roughly 18 times, but on a forward-looking standpoint, it was probably closer to the 10 to 12 number. So financial buyers will pay a premium for a platform business, and that begs the question of what exactly is a platform business. A platform business is one that has scalable infrastructure that can facilitate and accommodate growth with relative ease. It also typically has a strong management team, leadership team, and savvy operators who are running the business, and they have some centralized services that benefit all of the individual practices. Could be call centers, accounting services, insurance processing, and the like. What is not a platform business is what we call a collection of dots on a map. Basically, a group dental practice that has no centralized infrastructure and could be running altogether disparate systems, much like the guys from Denticon mentioned earlier to start. If you've got a patchwork quilt of different practice management systems in all of your different dental practices, you're most certainly not running a platform business. So how many times have you heard at the water cooler or the 19th hole or out to dinner sometimes some dentist say, I sold my business for $50 million. But what does that really mean? Did they walk away with $50 million in their back pocket and a check and they go off and buy an island in the Caribbean? It usually doesn't play out that way. Details matter a lot more than multiples, so let's take a look at deal structure from a foundational standpoint. We'll go through some things that we call term sheet terminology. Deal structure is made up of the sale price of the business, what the EBITDA multiple is, and that's all broken down between something called cash at close, that is cash in your back pocket, an earnout that you're going to achieve over some number of years with a dollar amount and a growth percentage tied to it. It's performance based, in other words, and it might also include something called an equity roll. And that's the ability to defer proceeds of the transaction into equity in the parent company if the parent company's intentions are to continue growth and ultimately sell at some point in the not too distant future. Internally, we call that the second bite of the apple, and it can sometimes be worth a lot. There are also other aspects to consider beyond just the deal structure, and those include employment details like compensation rate, the benefits package of the parent company, equity opportunities and where they reside, and then your employment contract and non-competes. Finally, the buyer makes a big difference, and it's important to know whether they're a financial or a strategic buyer and what their experience is in the dental space. So let's take a look at a potential transaction and break this down on a step-by-step method, and we'll see what the math means and what it might not mean. So in this situation, as an example, we have a $5 million EBITDA business. We have two buyers who are interested in the business. We'll just call them buyer A and buyer B. In this instance, buyer A is willing to offer $50 million for our business. That's a 10 times EBITDA multiple. Buyer B is only willing to offer $45 million, and that's a 9 times multiple. So if you stop right there, immediately you would say and conclude buyer A is the one that you want to sell your business to, right? Not exactly. The devil can be in the details, as they say. So the way these transactions are structured in this situation, buyer A wants to offer 50% cash at close. That's $25 million in your pocket. They want to structure 50%, the other 50% in an earnout. Buyer B, on the other hand, is going to offer 70% cash at close, which is $31.5 million. They're going to put 20% in an earnout, and they're going to allow you to defer 10% or $4.5 million into an equity roll. The earnouts are both structured over 4 years' time. In each year, I'm assuming that you meet the performance objectives and you ring the earnout bell and get the full payout. So in the first year of the earnout, buyer A is going to pay you $6.25 million, and buyer B is going to pay you $2.25 million on top of the 31.5 they paid you at the point of sale. In year, that's cash value per year. So in year one, the total value of the transaction for buyer A is $31.25, and buyer B, the total value of the transaction is $33,750. Buyer B is still ahead, so to speak. In years 2, 3, and 4, however, buyer A takes the lead, assuming that you ring all the bells in the earnout and get paid to the fullest. So at the end of those 4 years, you've achieved a $50 million sale price under buyer A's circumstances, and you've achieved a $40,500,000 sale price under buyer B. So clearly, buyer A is the buyer to go with in this situation. Well, I did say that 10% of the proceeds in buyer B was allowed for an equity roll. What does that look like over 4 years' time if the parent company, buyer B, continues to operate the business, grow the business, and then ultimately sell the business? Equity rolls can be worth a lot in terms of overall rate of return, some in excess of 900% that we've seen, and that's an unrealistic number that may never be achieved again. But suffice to say, they're buying your business with the intent of growing the overall business and then probably selling the business in its entirety at some point in time. So in this situation, we show that your $4.5 million of an equity roll 4 years later at a 300% return is valued at $13.5 million. And here we're showing that buyer B actually ends up being the better buyer in terms of overall value of the transaction. Now, let me push pause for just a quick second, because this is a simple math example to try to illustrate a point. I don't think have ever heard of, let alone seen, a 50% cash at close provision by any buyer. I'm sure there's one out there, but it's not the norm. The 70-20-10 is not unusual. Not every financial buyer or strategic buyer is going to allow for an equity roll. Some it's an option, some it's encouraged, some it's not an option at all. Every deal is different. The point in this is not to get hung up on necessarily the percentages here or there, but to understand that when you hear a $50 million, that some business sold for $50 million and it was a 10 times multiple, that's really sexy. That's kind of braggadocious. But the devil's really in the details. And I can all but assure you that those trades don't happen 100% in cash without any obligation at all to the seller. Usually, there is an employment contract that comes along with it. That's a way of saying that they're not going to write you a huge check and allow you to walk away from the business tomorrow and go buy an island in the Caribbean. They want you to stay on board. The compensation rate they're going to pay you from a clinical compensation standpoint is incredibly important after you become an employee. And then there are other aspects that are broken down, like are they covering your lab expenses or not, or some fraction thereof. Is there an employment agreement? How long is the employment agreement? And what's the non-compete radius detailed in it? Do they offer health benefits? You probably had to fund that out of pocket for your employees before. Many companies will fund that on your behalf going forward. Is there a retirement plan, and does the company match any of it? Do they cover your malpractice insurance? Do they cover your continuing education, or did they give you a budget for that? Is there ownership opportunity in either the PC or the DSO level? And is there an earned equity component where you could actually earn more equity in the business through something like a restricted stock unit vehicle? And then finally, I mentioned before, the buyer does matter. In this situation, they're both private equity companies that we're showing. One of them has healthcare experience. In this case, it's buyer A, and one does not. That's buyer B. And buyer A in this situation also has dental experience within healthcare, whereas buyer B has neither. The group that you choose to sell your business to matters a lot, and it can matter more than the number on the piece of the paper that they're willing to pay. You need to choose your partner wisely. So ultimately, what is the best deal? The best deal is one that balances your short-term and long-term expectations. Short-term expectations are things like your personal time frame, cash at close, that's cash in your pocket, employment details like compensation and benefit structure. Longer term are the characteristics of the buyer themselves. Is there an earnout structure and an equity roll provision? And what's the increase in enterprise value potentially down the road? The best deal is going to be the one that balances both of those short-term and long-term characteristics to the best of your needs as a seller. Thanks so much for attending or watching this webinar a second time. We really appreciate you being on the first one. Blake and I do. And suffice to say, if you have any questions about this webinar or anything else as it relates to cloud-based software systems or the world of M&A within the practice of dentistry, I hope you'll reach out to Blake Rice, president of PlanetDDS, or me, Perrin Desports, at TUSK Partners. Our contact information is there in front of you. We'd be happy to furnish a copy of this deck or any other information we can to help you out.